fun topic today, and I don't want anybody to miss out. So, check a couple of things. Looks like we're looking pretty good here. So, let's go ahead and get started. So, thank you. Welcome, everyone. Thank you for joining me here today. In the next 30 minutes or so, I'm going to talk about my journey of growing a $25,000 account into $1 million. So that's my goal, to show you exactly how I'm investing my own money. And if you stay until the end, you're going to learn how you can copy me, even if you know little to nothing about investing. Does that sound good? Excellent. So who am I and why should you even care what I have to say? Well, my name is Eric Hagan, and 2023 marks 20 years I've been helping people invest their life savings in the stock market. I'm a fully licensed, fully regulated financial advisor. I abide by a set of fiduciary standards, and I always put the best interests of my clients first. If you just go to Google and Google broker check Eric Hagan, you can get all the details. Broker check is a tool that shows you any regulated financial advisor's employment history, certifications, licenses, as well as any violations. I'm also a small business owner and president of the independent wealth management firm Capital Consulting Group here in the Twin Cities, Minnesota area. I've been awarded numerous top advisor awards, 5-star wealth manager awards. I've been featured in the Wall Street Journal, Forbes, Twin Cities Business, Minneapolis St. Paul Magazine. I've been asked to share my experience with hundreds of other advisors from all across the country. I got into this business right out of college. It's all I've done ever since. I received my degree from Bethel College, now Bethel University in St. Paul, Minnesota. On a more personal side, I met my wife Kelly at Bethel, and now we live in the Twin Cities with our 8 kids. I'm very proud of my family, but I share this with you so that you know that I get it. I understand. I know that life is busy, and I know that it's hard, if not impossible, to give your life savings the attention it deserves all on your own. If you are a busy professional, if you don't have the time, or if you would just rather spend your time doing something other than managing your life savings, then this message is for you. Now, as we get started, there are a few things I've learned over the past couple decades that I want to share with you. And the first is that when investing, what is comfortable will rarely be profitable. Have you ever heard the saying, no pain, no gain? Well, that applies to investing as well. There are no guarantees when it comes to investing. The way I invest means I can see big swings in the value of my account. It can go up, it can go down. So if you are here looking for more of a sure thing, what I'm going to talk about in the next few minutes is not for you. So that's number one. Number two, I've also learned that there is only one kind of investment advice that actually matters. And there are many places you can get investment advice. You can get it from watching TV. You can get it from the radio, from the newspaper. You can get it now on social media. A lot of people subscribe to email newsletters. You can get it from family and friends. And there's one thing that all of these places have in common. None of them take you in your unique situation into account. None of them know your financial situation and how their investment advice impacts your financial future. None of them are accountable to you. And that is why the only investment advice that actually matters is the kind that is accountable to you. So that's number two. And then lastly, I've learned that if you don't know what your investments cost, you're probably paying too much. Most of the financial services industry is made up of products, and all the big firms are fighting hard to get you to buy them. Here's what I mean. Let's take a look at mutual funds, a very popular investment product. Most people understand that there is a cost, something called an expense ratio, that the mutual fund company charges for its management of the fund. But there are other costs more below the surface that are very hard to determine and even harder to calculate. There's things like transaction costs, tax costs, cash drag, soft dollar costs, and all these are in addition to any financial advisor fees, commissions, sales loads, and more. I have several resources that puts the total annual costs of many mutual funds to be between 3 and 4% every year. And that is before you add in the cost of a financial advisor. Think about this. If you have a $100,000 account and you are invested in mutual funds, then your cost could run up to $3,000 to $4,000 or more every single year. How much is that going to be over the next 10 years, over the next 20 years? Don't believe me? Google it. A simple Google search yields results like this on the very first page. How mutual fund trading costs hurt your bottom line. The mutual fund fees we don't talk about. Uncovering hidden costs of mutual fund investing. Shedding light on invisible costs. And the list goes on and on and on. I've spent about 20 years talking with individual investors, taking apart their portfolios, putting them back together. I've literally had thousands of conversations with investors over my career. And I can tell you that not a single person I've ever talked to about this knew these additional costs even existed. This means today you get to tap into all those conversations in just the next few minutes. You don't have to do for the next 10 or 20 years what I've been doing for the last couple of decades. Are you actually paying more than you think? If you don't know what you're paying, you might be. So, those are the things that I've learned, among many others, but some important things I wanted to share with you here today. So, next, let's look at what you're going to learn today. Specifically, there are three things that I'm going to teach you today. Number one, I'm going to teach you how to avoid all the internal expenses of mutual funds and annuities, even the hidden ones, without paying a commission, load, sales charge, or hidden cost ever again. And then number two, we're going to look at the weird, almost backwards investing secret for growing almost any kind of an account, whether it's an IRA, a Roth IRA, individual or joint accounts, old 401ks, trusts, simple IRAs, and more. And then lastly, we're going to look at the three essential ingredients required for all investment success. And if even one is missing, failure is going to be guaranteed. So let's start with number one. Remember, investment products like mutual funds and annuities have internal expenses and costs that are hard to understand, hard to calculate, and hard to truly know. Mutual funds can easily cost 3% or more each year, and annuities can easily be over 5% per year or more. And that's the first step that really makes this different. I'm not going to show you the next mutual fund to own or any type of annuity. This isn't any kind of pooled investment like a REIT, limited partnership, business development company, or otherwise. It does not tie your money up. It does not have a surrender period. What we're going to talk about is not a product to buy from some big investment or insurance company trying to sell you something. Instead, we're going to get back to what the heart of investing in the stock market really is. And that is investing in individual companies, in individual stocks of companies. When you own shares of individual stocks, there are no internal expenses, none. Investing in individual stocks have no internal expenses or costs. So to do this, I use a special type of account that allows for unlimited trading for one flat fee. This means I can buy, sell, trade as much as I want, as often as I want, and the cost is one flat fee. No commissions, loads, sales charges, etc. This single fee covers everything. Now we call it Contour because it works for just about any kind of an account, and every account is separate and unique from all the others. My account that I'm talking about today is a regular taxable account, but you can have a Contour account for an IRA, a Roth IRA, individual like I have, or joint accounts, trust accounts, simple IRAs, and others. So that's number one, how to avoid all the internal expenses of mutual funds and annuities, even all those hidden ones, without paying a commission, load, sales charge, or hidden cost ever again. Number two, we're going to look at the weird, almost backwards investing secret for growing almost any kind of an account. Again, whether it's an IRA, Roth IRA, individual joint account, old 401ks, trust, simple IRAs, and more. And so this secret is to have a strategy. Strategy is a lot like a blueprint when you're building a new home. The blueprint tells you what materials to order to build the home and how much of each that is needed. An investment strategy tells you what to invest in, how much to invest in, and when to make a change. A strategy is a repeatable process that can be done over long periods of time. It means that what I invest my money in is not based on my gut feeling or what I think is going to do well. And it allows us to remove the emotion from investing and replace it with discipline. So, again, when it comes to investing, a strategy helps you know what to invest in and when to make a change. Ready to see what I mean? Here we go. Get your notepad ready. Today, I am investing my own money in 30 individual stocks and 30 individual companies. And what I'm going to show you next is my strategy for picking those 30 stocks to be invested in. Did you know that there are more than 6,000 stocks that you can invest in on the New York Stock Exchange and the NASDAQ? Now, some of these companies will be here and doing well many years from now. Some will be gone or fall out of favor much sooner. Because I am an investor and not a trader, what I want to do is to identify those companies today who will be around and doing well for many years into the future. So, to do this, I want you to think of stocks or companies as being like a medieval castle. The same way a moat protected castles, there are certain characteristics companies can have that protect their ability to be and remain profitable. The more a company can protect its ability to be and remain profitable, the more they have a long term sustainable competitive advantage. I want to invest in companies today with a wide economic moat around them. So, to find companies with a wide economic moat around them, what we do is we go to Morningstar. Morningstar is the world's largest investment research firm for financial advisors. Currently, Morningstar has a team of over 100 analysts whose sole job it is to look at all those 6,000 companies and rank them all based on their moat. Some stocks have no moat, some have a medium moat, some have a wide moat. At last count, these analysts identified 311 companies as having a wide moat, meaning they determined that 311 stocks out of those 6,000 would have a sustainable competitive advantage for at least the next 20 years. Now, 311 stocks is far too many to try to invest in all at the same time. So, what we need to do is filter these 311 companies down to a much more manageable amount, in this case, of just 30 stocks. So to do this, the next thing I did is I hired my own chief investment officer. His name is Tom. Tom has over 35 years in the investment business. If you look at this slide here, you can see he has a very long resume. A few points to note. At his previous firm, he managed over $1.5 billion. Notable fact, he presented his proprietary research to the Federal Reserve Board's Investment Committee. And so, again, you can see he's got a very impressive resume. What Tom does is he goes through that list of 311 wide economic moat stocks. And the first thing he looks for are those ones that are less expensive than the others. If you've ever heard the saying, buy low, sell high, this is exactly what he's trying to do. He does this by searching for those stocks that are trading at a discount. And then he looks for those that are gaining momentum in the markets. Have you ever heard the saying that a body in motion tends to stay in motion? Well, the idea here is similar in that a stock in motion tends to stay also in motion. And after this rigorous filtering process is done, Tom is able to boil those 311 wide moat stocks down to just 30 individual companies, 30 individual stocks. And these are the individual stocks that I'm investing my own money in my own account. Now, over time, these stocks that I'm in can change. And that's because this is an ongoing process. This is not something that is done once and then I just sit on them. This process is re-reviewed on a regular basis. When companies that I own no longer meet this filtering process, they are sold and replaced with ones that do. So, does it work? Well, here's what I can say. Over the past 5 years, as of March 1st, 2023, the S&P 500, as represented by that spider S&P 500 ETF at the bottom of your screen, which is an index many people use to measure how the stock market is doing in general, is up about 60%. So even with the recent pullback here the past year, even with COVID, even with that dip we saw the end of 18 with interest rates, despite all of those pullbacks, those drops and dips, the entire stock market, again, as represented by this S&P 500, is up 60.7%. Now, over this exact same time frame, these 30 stocks, these wide moat stocks that we've selected as a whole, have gone up in value by 125.7%. This means that if you had put $10,000 in that S&P 500 ETF 5 years ago, you would have seen an increase of over $6,000. However, if you had put the same $10,000 in these 30 wide moat stocks I just described, you would have seen an increase of over $12,000. And this is all in just 5 short years. Again, despite the recent pullback, despite COVID, and despite that dip that we saw at the end of 18, early 19. Now, if you want to know exactly which stocks these are, be sure to stick around until the end and I'll explain how you can get a list of them. And remember, if you have an IRA, Roth IRA, simple IRA, old 401ks, regular investment accounts, I'll also show you how you can copy me and you can invest in these stocks in any or all of your accounts, even if you know little to nothing about investing. Now, moving on, I actually want to take this strategy one step further. Another important thing about this strategy is that sometimes the markets go through periods where it is better to not be invested at all. So let me explain. Now, obviously, none of us were alive in 1900, but let's say that you were able to put $200 in the stock market, the S&P 500, for instance, in 1900, and you left that money alone until 2022. In 2022, you'd have an account valued at over $17 million. However, if you had invested that same $200 in 1900 and missed just the 30 best months during those 122 years, meaning you did not get the good returns of just those 30 best months, you of course would not have $17 million. You'd have less than that. But would it surprise you to know that those 30 months, missing those 30 months, you'd only have 578,000. That's a big difference. With this type of information, it is no wonder Wall Street has preached buy and hold as the way to outperform. And you might be thinking $17 million sounds pretty good to me. Well, what I'm here to share with you, however, is the whole story. You see, if you had taken the same $200 from 1900 to 2022, you didn't buy and hold, you didn't miss the best 30 months, but instead you missed just the 30 worst months, you wouldn't have $17 million. You wouldn't have $578,000. Instead, you'd have more than $45 million. Now, let's look at the same thing, but over a much shorter time period. And now let's say that you invested $2,000. If you had put $2,000 in the S&P 500 in the year 2000, in 2022, you'd have an account valued at just over $8,000. However, if you had put the same $2,000 in the year 2000 and missed just the 10 best months during those 22 years, meaning you did not get the good returns of those few 10 months, you wouldn't have $8,000. You'd instead have just $4,000. Now, if you had taken the same $2,000 from 2000 to 2020 or to 2022, 22s, and didn't buy and hold, didn't miss the 10 best months, but instead missed just the 10 worst months, you wouldn't have $8,000. You wouldn't have $4,000. Instead, you'd have more than $26,000. I think this illustration helps explain Warren Buffett's 2 rules for investing. Rule number 1, don't lose money. Rule number 2, don't forget about rule number 1. Now, you may be thinking, yeah, but is it even possible to miss the worst times in the markets? And the answer is a little bit complicated. What I can say is that it is harder to be in the right place at the right time than it is to avoid being in the wrong place at the wrong time. Here's what I mean. Let's say that you sit down to play poker and you are dealt your hand. Are the odds of being dealt a royal flush high or low? It's low, right? Did you know, though, that it's actually 1 in 649,740? To put this into perspective, if you were dealt 20 hands every night over your lifetime, you could expect to get a royal flush one time. That's 89 years. Now let's say that you're outside, maybe you're golfing, and you see a lightning storm coming. Are the odds of you being struck by lightning high or low? If you think about it, it's low, right? Why are the odds low? Because if you can see the lightning storm coming, you can just go inside, right? So what's easier, being in the right place at the right time, getting dealt that royal flush, or avoiding being in the wrong place at the wrong time, going inside when you see a storm coming? Let's do it again. Is it easy to win the lottery? No, right? Otherwise, everyone would do it. But if you're going to build a new home and you don't want your new home to flood, should you build your home on a floodplain? No, because when it floods, your house would be in the wrong place at the wrong time. So what's easier, winning the lottery or deciding not to build a new home on a floodplain? I believe the same thing about investing. It is much harder to pick the next huge stock winner than it is to know when the overall markets are getting ready for a pullback. And that's why sometimes the best offense is a good defense. We watch the markets every day and we monitor a number of different resources to help us identify if it would be wise to sell some or all of my stocks and go to cash in order to protect my account value from going down. So that's my process. Instead of trying to pick the next hot stock, we have a strategy for what to invest in, when to make a change, and when to get out of the way. So that's number two. The weird, almost backwards investing secret is to have a strategy, a repeatable process that you can implement over long periods of time. Finally, number three, the three essential ingredients required for all investment success. And if even one is missing, failure is guaranteed. So the first ingredient that we need is an account that we put money or capital into. You need something to start with, and you also need to add to it. So remember, I have my own Contour account where I get the unlimited trading for one flat fee, and I put money in it, right? I started by putting $25,000 of my own money into that account. And I'm also adding $100 to it every single month. So that's ingredient number one. The next thing that you must have is time. And this is such an important component. And in my case, for my unique situation, this is money I plan on leaving alone for a long time, for 30 years. I'm tapping into the principles of time in the market, not timing the market. And then the last ingredient we have to have is a return or an ROI or return on investment. Now, I don't know what my average return will be in the future, and I'm going to show you what 12% looks like. Something to know when we look at projections is that it's very rare to hit the average anyway. It's kind of like telling someone who's never been to Minnesota that the average temperature is 50 degrees. Telling them that would not give them a good idea of what to expect if they were to visit. In the winter, it gets below zero. Summers are beautiful, getting into the 80s and 90s. So again, the average is 50, but it's very rare that the temperature is actually 50. The same thing can be said about investing. Sometimes the markets are up, sometimes the markets are down. And over time, we can determine the average, but it's very rare we actually get the average. I believe that in the future, when we look back, a 12% average return is not out of the question. And if that's the case, when you do the math, $25,000 today plus $100 a month for 30 years at a 12% average return, the ending balance is just over $1 million. This is the magic of compound interest. By me personally just setting aside $61,000 over that time, I'm projecting to grow it over $996,000. Now, the one thing we know is that if you change any one of these three components, you change the end result. Let's say that you have $100,000 saved today, and you can add the same $100 a month that I'm adding, but you only have 20 years. Well, at the same average return, you too would end up with just over $1 million. Or maybe you're closer to retirement. Maybe you have $250,000 today. You're in your higher earning years and you're adding $1,000 a month, but you've got just 10 years to grow it. If that sounds more like you too would end up with just over $1 million. The amount of money you have, the amount of time you can give it to grow, and the return that you get, these things are all unique to you. If you change any one of these three components, you change the end result. So again, we just learned, number one, how to avoid all the internal expenses of mutual funds and annuities, even those hidden ones. We learned the weird, almost backwards investing secret, and that is to have a strategy. And then we just looked at the three essential ingredients required for all investment success. In other words, number one, we learned we need to invest in individual stocks. Number two, we learned that we have to have a repeatable process, a strategy for what to buy and when to make a change. This process removes the emotion and replaces it with discipline. And then lastly, I've set money aside and I'm giving it time to grow. I'm giving it time to work. So that is how I'm working every day to grow my own $25,000 account to $1 million. And my invitation to you is to follow along on my journey at investlikeeric.com on a regular basis. I'm posting updates. I'll share what the balance of my account is. I'll show you when I'm making trades, when I'm selling certain stocks and buying new ones. I'll show you what I'm selling and what I'm buying. I'll share performance updates. I'll share the next time that we decide to sell everything and go to safety. I'll post an update for that too. Now, you might be watching this years after I got started, and that's okay. You can go back and watch my journey from the beginning. I'm putting it all out there. So, again, after today's presentation, if you have not already, I invite you to visit me online at investlikeeric.com, see where I'm at in my journey from 25,000 to a million, and absolutely subscribe to my email list so that you can get notified when I post a new update. Now, I promise that if you stayed until the end today, I'd show you how you can easily copy me, even if you know little to nothing about investing. And that's really what makes this different. Like I said, 2023 marks 20 years I've been helping people invest their money in the stock market. A seemingly simple request I've received numerous times over the years is, Eric, can you just invest my money the same way you invest your own? And the answer is yes. I can invest your life savings the same way I'm investing my own money. I'll invest your account in the same 30 stocks I'm invested in today myself. If I sell any of those stocks, I'll also sell the same ones in your account. If I buy new stocks in my account, I'll buy the same new stocks in your account. If I decide to sell everything and go to safety because I think there's a bigger downturn coming and I want to protect my account value, I'll do the same thing in your account. When your account gets billed a fee, I'll bill my account the same fee and I'll give mine to charity. I will invest your life savings the same way I invest my own. Here's how it works. Remember earlier I told you about my unique Contour account, the one that I pay one flat fee for unlimited trading. Well, we can open the same type of an account for you. This is your own separate account. Your money is not combined or commingled with anyone else. You get your own statements, your own tax forms, your own reporting, your own 24/7 online access. And this is where it gets really cool. Remember the wide moat castle strategy I explained earlier? Anytime Tom and I make changes to the strategy, those same changes are made in each of our accounts at the same time automatically. This means that if the strategy says it's time to sell a particular stock and buy a new one, that stock is sold in both my account and in your account at the same time, and replaced with the new one in my account and in your account automatically at the same time. So think about all the different types of savings accounts that you have. Whether you have money saved up in an IRA, a Roth IRA, maybe you have old 401ks that you left at previous employers, or maybe you have individual or jointly owned taxable accounts. Maybe you have savings held direct with mutual fund companies. There are a lot of ways that this can work for you. You can have your own contour account for any or all of these. Maybe you have $25,000 in a Roth IRA and have $250,000 in a regular IRA. Perhaps you have several old 401ks out there. My team and I can help you consolidate them and have them invested the same way I'm investing my own money. We have many clients who are doing this with multi-million dollar accounts. So if that sounds like you, this can work for you too. But we also work with many people with much smaller amounts saved. If that sounds like you, we want you to know that this can work for you too, and we look forward to the opportunity to show you how. So, if you have $25,000 in a single account, or if you have 250,000, 2.5 million, or $25 million in many different accounts, I will invest your life savings the same way I invest my own money. So if you are at all interested in having me do this and having me invest your life savings the same way I'm investing my own, here's what happens next. In a minute, I'm going to point you to a pre-qualification survey. The strategy I use for my own money is not right for everyone, and this is important. I have to abide by a fiduciary standard. Remember, I'm a fully licensed and fully regulated financial advisor. Your time is valuable, and I don't want to waste it. So the next thing that you need to do is to take a short online pre-qualification survey. After you take the survey, and if you do pre-qualify, you'll then be taken to a web page with my calendar on it. And you'll be able to schedule a one-on-one Zoom meeting with me personally. Now, as soon as you schedule this meeting, you'll be sent a confirmation email with a list of the exact stocks that I'm invested in right now. So if you want to know what those 30 stocks are, I'll be able to send it to you as part of that email. Now, at this Zoom meeting, our agenda will be to do three things. Number one, I'm going to answer any questions that you have. We covered a lot today, and what I'm offering is very unique. I have not heard of anyone else doing this, so I'm sure you have questions. Number two, we'll discuss your personal situation and come up with a game plan unique to you in your personal situation. We'll look at any and all of the different kinds of accounts you have. Again, whether you have IRAs, Roth IRAs, individual or joint accounts, money held directly with mutual funds, trust accounts. We can even help you convert and maybe consolidate old 401k accounts that you may have into an IRA. You are unique, and there is no one size fits all plan. And then lastly, I'll explain how we actually implement your plan. I'll share with you the process for getting you from where you are now to where you want to be based on that personalized plan that we put together. My team and I are here to help you every step of the way, and we want to make any changes as easy and pain-free for you as possible. So with that, I'm going to point you over to investlikeeric.com. Scroll down, click on the pre-qualification button, take the short questionnaire, see if you qualify. And if you do, grab a spot on my calendar for this short Zoom call. Again, one-on-one with me personally. That concludes today's presentation. Thank you for spending some time with me here today. I hope this presentation helped you see a different way of doing things, and I hope to see you on my calendar very soon. So again, head on over to investlikeeric.com, and I'll look for you on the calendar very soon. Bye, everybody.